Bottom line, this is not the chart I'll be watching to look for a bottom in the market. This is oversimplified, but it is a basic outline of what I see. Some argue that supply chain is the basis for a good portion of the economic troubles we are seeing. And I'm not going to disagree, but it's hard to see supply chain problems on a chart. So for me, I'm going to have to come up with an alternative signal for an easement in the supply chain problem. First of all, let's identify what the problem is. We want to know when the downtrend we are currently in will bottom out so we are not holding our shorts when the market turns. Notice the careful wording there. I'm talking about bottoming, not starting a new uptrend. The market may travel sideways for a period of months or even years like it did in the 70s, which is when the last time we saw inflation get out of hand because of supply chain problems. Back then it was oil. Today the supply chain is even more messed up. As I see it, the problem is not inflation or interest rate. It is in fact the supply chain that will do the U.S. economy in, and it is going to be very bad. The cause of the supply chain problems are numerous, and some causes can be difficult to control. But the Fed can help out indirectly by using various tools to tighten the money supply. People seem most interested in the prime lending rate, which is the rate banks charge their institutional borrowers. And it ends up showing up in car loans, mortgage rates, credit cards, in just about all loans. Remember, the Fed has two jobs: keep unemployment low, keep inflation low. Right now, unemployment is not the problem. Inflation is. Here is the crux of the predicament. Consumers seem to be awash with funds at the moment. So by raising interest rate, the Fed is actually contributing to the inflation problem in the short term because the institutions tend to price that interest into their goods and services. And yet, it seems that people have been able to keep up with the inflation so far. Otherwise, inflation would have stalled out, which is the original purpose of the rate hikes. As inflation continues to pace along at 8% or so, the Fed has to keep raising rates. Remember, the Fed's inflationary goal is about 2% inflation. How high does the Fed want to raise interest rates? As you can see, back in December 1980, the Fed, under the chairmanship of Paul Volcker, once raised rates to 21.5%. This would make your $500,000 mortgage at 20% interest over $8,000 a month, not including taxes and insurance. Could it happen? The reality is rates probably won't reach those heights again this time around. But the problem is, as long as there is low unemployment and consumers have the resources to keep up with inflation, the Fed will most likely continue to raise rates. This is why identifying the problem as the supply chain issue is important. The last time we had a supply chain problem, things got out of hand. We're talking about inflation at almost 15%. Only when unemployment starts to creep upward, which the Fed is trying to avoid, can we start to look for a cooling off of inflation and therefore interest rates. That is only the beginning though. There will be a lot of consolidation before the economy starts to pick up. But the market is predictive, so we might get our bottom when unemployment ticks up for more than just a month and isn't considered transitory. The longer the economy sputters along and the longer inflation hangs around and the higher interest rates will get, which will ultimately lead to an even longer drawn out economic downturn, we've got a long way before the market bottoms out. Bottom line, this is not the chart I'll be watching to look for a bottom in the market, but this one is.